Welcome everyone to a final webinar for the 2014 season. Today's topic is revenue management. What we've done in the past usually is an end-of-year wrap-up, but we started to switch it up this year and focus on revenue since everyone's heads down doing year-end close or preparing for year-end close for many of you. Before I get into the real crux of the material, just to give you some heads up on what's coming in 2015 for TopStep. We are doing OpenAir user groups again. Those will start up in the February timeframe. Our first one is in Dallas. We're looking for a location to host that. And then another one will be in the UK. We're starting those back up in our overseas office that we just opened in the fall. The webinar series will also continue. We're getting all of those dates scheduled and the topics lined up for all of 2014. We're going to kick off January with user administration and all the different pieces and parts that go into administrating the users of your system and giving them their unique experience, and that's going to be on January 15th. It's not on our website yet, but it will be there within the week. And then just because I want everyone, just a reminder to everyone, if you haven't already done this in your systems, don't forget that starting January 1, that's the 2015 holiday schedule. Those of you who are doing revenue or resource management will definitely want to get those holidays in and people putting timesheets in the system. And then, of course, there's always many of you have annual salary adjustments, cost rate adjustment, rates card adjustments. So just don't forget those year-end maintenance activities in the system as you look forward to starting off another successful year in your organizations. So what will we be covering today in the revenue management topic? So revenue is a pretty important topic for lots of folks because that's obviously what we're recording as what the earnings are for the company based on OpenAir's calculations. So I want to talk a little bit about what's the difference between invoicing and revenue and why OpenAir treats them separate. We're going to go into depth into the revenue rules and the policies that those support in the system, give you some typical scenarios and what to consider as you're trying to figure out how to set up your revenue rules in the system. And then we're going to dive into a couple of more advanced topics, things like accounting periods, why you use them in the system, and then handling deferred revenue options. And we'll touch on a feature that came out a couple years ago called revenue containers. Not something for everyone, but just so that you know it's a feature available, which has a whole other set of capabilities very similar to accounting practices. So let's start off with invoicing versus revenue. So many of you are aware that OpenAir does support invoicing. There's billing rules in the system, but it also supports revenue recognition. Many of you may also have those revenue recognition rules turned on. If you don't, you can contact NetSuite OpenAir support and have those enabled. But revenue recognition actually has its own set of rules and is actually treated separately from invoicing in the OpenAir environment because revenue is not always connected to invoicing. If you are one of those lucky few that invoicing is always revenue recognition, then this is more informative for you, but most organizations have some kind of disconnect between the invoicing and revenue recognition. Things like you have to invoice the customer before you can recognize revenue. Maybe you're doing prepayments to the customer and then you recognize the revenue as you work it. Maybe you're doing milestone or payment schedules with the customer for large, maybe bundled deals, and the revenue is recognized differently according to how the work's delivered or the milestones that have been hit as far as the project plan is concerned, different than the invoicing milestones. Maybe even it's something like license carve-out recognition. Those of you who have to deal with VSO where you're doing invoicing of labor in one rate, but you're recognizing revenue maybe at a higher rate because you're getting an accommodation for maybe some license fee sharing with the services organization. So there are a lot of scenarios, too many to rattle off here, but a lot of scenarios where the invoicing activity is not directly the same as the revenue recognition. And your finance and your accounting teams probably have a very focused understanding of what the revenue policies are in your organization, and they're probably published somewhere. But before I get into the actual revenue recognition rules, I want to highlight there are a couple of revenue controls in the system in general. So if you do have revenue recognition rules turned on and you're starting to use those, There's a couple of controls that have sort of flown under the radar unless you've had a real need for these. And I thought I would take a moment and just kind of highlight these controls that have been released in the past couple of years. So in May 2012, there was a feature introduced at the project level which gave you the ability to check a box to say, prevent this project from being invoiced or recognizing revenue. It's a bundled feature between invoicing and revenue recognition. And typically how that was handled before this feature came out is there would be some kind of filter sets, or the pending billing or pending recognition reports would be filtered on project stages. So you would avoid picking up certain projects, or you would just not put rules on them in general. But this release came up with a feature that allows you to sort of mix and match. If you do have projects in a certain stage, maybe some of them can be recognized for revenue, some of them can't, depending on what your business process or business need is. So this feature came out so that you can actually, at each project, determine if it's something that can be invoiced and recognized for revenue. However, earlier this year, actually, there was an enhancement to the system that brought it down even further. Before, like the old school method, filter on project stage, the May 2012 method introduced by project, and now you can actually go down to the individual customer PO. And the customer PO feature released in May gives you the ability to add this checkbox on the PO to prevent invoicing and revenue that's being associated to a specific customer PO or agreement in the system. And really the reasons for that is if you know a PO is coming, you haven't gotten the PO issued yet, so you set up sort of a temporary customer PO. Maybe you even call it something like need PO. And that way you have something to set up against the project. You have something to put into the rules so that when the PO gets issued by the customer, you simply go and rename that temporary PO to the actual PO number with the amount in it. But you want to prevent your billing team or your finance team from doing any invoicing against that temporary setup because it hasn't been officially released. So you can actually add this checkbox on the customer PO, which then would actually prevent you from doing any invoicing against that temporary setup. As many of you know, a lot of things in OpenAir are sort of set it up in the front, set it up at the beginning of the project, and sort of set it and forget it. So these kind of controls are being introduced to continue to support that set it and forget it. Try to get as much done in advance before you actually have to do the month-end crunch of generating invoicing and revenue recognition and having to close the books in a certain amount of time. So what are revenue rules? If you're not familiar with revenue rules, there are actually 8 different kinds of revenue rules, which is very different from invoicing. Invoicing is driven by billing rules on the project, and there are only 5 kind of billing rules in the system. So there's 8 different revenue recognition rules, which just sort of points to the fact that revenue can be handled very differently depending on the type of company you have, the policies that you have, the type of contracts that you deliver. So we're going to kind of go into each one of these and kind of explain what it is that they do and how you can manage or control your revenue recognition based on how each of these rules are set up. And the first one, which is sort of the simplest, but actually it can be pretty complicated depending on how you need to control things, is the as-billed rule. Now the as-billed rule is the basic concept of this is it connects to the billing rule. Right? Whatever you invoice or whatever comes out of a billing rule, you can recognize as revenue. And this is one of those, if you 99% of the time everything you invoice is the same as revenue, you would typically use an as-billed rule. You would pick up whatever you put onto the invoice or ran out of billing rules and pick it up and generate revenue transactions in the OpenAir system. So before you jump in and start using this rule, the things you have to consider are, do the charges that are coming out of the billing rules, do they have to be on an invoice or not? That's actually an internal switch that you can put in the system that says you cannot recognize revenue until it's put on an invoice, okay, in case you didn't know that. Or you can have the other option, which is I don't care if the charge is on an invoice or not, you can go ahead and recognize it as revenue. Do you need what kind of charges are you dealing with? Are you dealing with both time and expense? Are each of those billing charges a different service? For example, like one is accruing You would put revenue in like a reimbursed expense service versus labor or consulting fees service. So how would you set up the rules to accommodate two different services coming in based on the billing transactions? And is there actually an invoice in general related to the billing for this customer? So there's typical scenarios. The first typical scenario is part of the easiest scenario is anything that comes out of a billing rule I recognize. There's no filters. There's no sort of service or activity overrides. You don't have to do any invoicing. It's just whatever comes out of a billing rule you can recognize as revenue. In those scenarios, if that is all of your projects, like 100% of your projects would be recognized as revenue like this, you may not actually need to use revenue recognition in OpenAir. The only caveat I have on that is if you have to deal with accounting periods and when the work was done. So that may be the only driver for it, and we'll talk about accounting periods a little bit later. The other type is what if you're doing both time and expense, but each of those has a different type of service that has to be recognized. Expense has to go against reimbursed expenses. Labor has to be categorized according to like consulting fees or something. You actually can set up two as-billed rules because it has filters associated to the rule that says whether it should pick up hourly charges or expense charges or flat fee charges or other charges, like do you include or exclude them. And it also supports charge stages. So it's very similar to projects, the projects module, where you have different project stages where you categorize projects according to your life cycle for most of you. You can actually set up different charge stages in the invoices module, and the charge stages can satisfy revenue policies or reporting needs such as write-offs, prepaids, things that are like not invoiceable. You're using it just for comparative purposes. So the as-billed rule can have those filters based on types of charges to satisfy the time and expense billing situation, or you can actually filter by charge stage and only pick up charges from a certain stage. An example I see of this often is you're billing a customer up front prepaid services. So you had the customer pay for 80 hours, but you recognize the work as it's been delivered, which you would generate from a time billing rule perhaps, and you would put the charges from the time billing rule in a charge stage called non-invoiceable. And those would not be able to be invoiced, but that would be the stage that the as-billed rule would point to. So there's many combinations on how to satisfy the prepaid situation. It all depends on what you need to show the customer and how you need to support reporting. Okay. And then just time billing in general, maybe you're required that you have to have an invoice, so you would flip the internal switch to say, time billing has to be on an invoice. Once it is on the invoice, then you can go ahead and recognize the revenue in the system. If you're not familiar with this rule or haven't seen this rule before, I'll just kind of show you a couple of examples of rules in the system. So the as-billed is pretty basic. You have charges that you can exclude, and then charge stages if you have multiple charges stages set up on what to include or exclude from a charge stage perspective. If you don't have charge stages set up, then your charge stage is automatically considered blank in the system. So there was really no way to sort of filter on a blank value. It's only if you do set up additional charge stages that you can use this filter. Now, the next two sets of rules, they sound like they're similar, but they actually do things very differently. And one's called a percent complete, and the other one is called fixed fee on percent complete. Okay, percent complete. The rule here is very different from any of the billing type rules, is because what it does is it computes a percent complete of the project based on information configured on the rule, and it will tell the system, oh, I think the project is 76% complete, and you tell the rule what the total value of the project is. Then it takes that 76% or whatever the percentage is and multiplies by that revenue total and comes up with how much revenue you should recognize on the project at that time. Okay, pretty common when you're dealing with sort of fixed price projects. This is sort of a work delivered recognition model, and the percent complete rule, there's switches that you can turn on that would also, when you're doing forecasting, would consider the work that's already been recognized. So you're getting a sort of a delta forecast of revenue recognition going forward in the forecasting. We have a whole other webinar, I think, done earlier this year, at the end of last year, for percent complete. So there's lots more information about this topic if you'd like to find out about it. But in general, before you start using a percent complete model, you have to understand, like, how are you managing the effort that is supposed to be associated to this project. And when I say effort, I mean planned hours. Are you using planned hours, which is the task assignment? Are you using budget hours at the project level? Are you using estimated hours, which is sort of an hours remaining refinement feature that project managers can take advantage of? All those questions drive, what does percent complete mean to you? How is percent complete calculated? And that's very important, because making sure you understand and agree with how it's computing percent complete obviously then directly impacts how you recognize the revenue and who controls when that revenue recognition is done. Okay, so the percent complete model will use the hours features on the tasks or at the project level if you use budget hours. It will actually, you can do percent complete recognition at phases, at task level, at the full project level. You can filter it on certain tasks, so you have the ability to sort of limit what contributes to the percent complete, especially for those projects that you may have where you have non-billable hours and for some reason you want to exclude those from consideration of the percent complete calculation. So the percent complete calculation deals with the calculating of hours that have been completed versus the total hours known to the project, and sort of defining what those two values mean is important before you consider using this rule. Okay, it is an hours-based percent complete calculation. Okay, the rule itself has 5 different features on it, though. There's 2 of them that are related to percent complete and 3 of them that are related to hours. At the end of the day, they may all mean the exact same thing depending on how you have your system configured. But percent complete by default will be approved hours over planned hours, unless you have the hours remaining feature turned on, and in that case it defaults to approved hours over estimated hours. Okay? But if you don't want that, you can always have OpenAir support switch it back to the standard approved hours over planned hours. So there's a couple of controls that you have related to what percent complete really means in OpenAir. However, if you want OpenAir to do the percent complete based on estimated hours, but you want more control based on planned hours, you can override that by using the other one of the other 3 features, which is dealing with just the timesheet approved hours and the planned hours on the project. So you can ignore the percent complete calculation that OpenAir is doing and force it to use planned hours and approved hours for the project or a specific task or a specific phase of tasks. Okay. And then finally, there's one option, which is you can actually use the budget hours feature. Some of you may have hidden this on your project properties form, but it is a single full field on the project properties form right next to budget money called budget hours. And it's really meant to hold the total number of hours for the project. Some of you may use that, some of you may not, because you know that it's available by reports by just pulling all the planned hours across the tasks. But if you use that budget hours, you can also use that as part of your percent complete rule calculation. Okay. And what I find is typically if there has to be some kind of control at the accounting level, accounting doesn't necessarily need to understand the tasks and the activities, so they would be controlling sort of the budget hours field, and that would control the percent complete calculation. Okay. If you're dealing with project managers controlling the project plan and the percent complete, then the project managers would not use budget hours. They would use task level information like planned hours or even the percent complete calculation. So which percent complete calculation is right for me? It really depends on, again, how you are capturing time and how your project managers are managing the project. So when you set up a project, all tasks ideally will have a planned hours associated with them. So how many hours will it take for this task to be delivered? That could be split among the people who are also assigned to work on the project. So there's a way to put hours just at the task level. there's a way to put hours assigned to individual people, and that rolls up to the task level. But if you're using, if you're doing hours, planned hours at the task level, typically your percent complete then would be approved hours over planned hours. Okay. If you are assigning hours to individual people, you may turn on this feature called hours remaining. It gives users the ability to override how many hours they need to finish the task on their timesheet, which then contributes to another calculation in the project called estimated hours. And this is a project management control to be able to do more of an estimate at completion versus the original plan. And when you have the hours remaining turned on, it does flip the percent complete calculation to use the estimated hours, but you can always have NetSuite support reset that back to the original planned hours if you want. Okay, so there are pros and cons for using the various percent complete calculations, but just the key is understanding how your system is doing the percent complete so that when you use the percent complete recognition rule, you understand how it's computing that. Now, the fixed fee on percent complete is a different type of recognition rule, and that recognition rule recognizes a fixed amount of money when a certain percent complete is hit. So it's almost the reverse of the percent complete rule that we just went through. The percent complete rule says, here's how much money I could possibly recognize for the whole project, and then you figure out a percentage of what to actually recognize. This one flips it around and says, I recognize X amount of dollars when the project hits this percent complete. And of course, again, here you'd have to understand what the percent complete calculation really is all about in order to make sure you're comfortable that if you're hitting 50% of the project and you can recognize a chunk of money, that of course you're actually at 50% of the project. So things to understand when you're using this is there some kind of more of a milestone based, more of a percentage completion based that you can't attach to, you can't really attach to sort of individual hours. You have to set it up on some kind of periodic schedule for recognition. And I see this a lot when it comes to things like milestone completion. So when this milestone is 100% complete, I can recognize $50,000. Okay. So the fixed fee on percent complete, I tend to think of it more as a milestone completion approach where you can give your project managers the ability to control the percent complete calculation and the percent complete value at the task or milestone level. The things to keep in mind between these two types of rules, the fixed fee on percent complete and the percent complete recognition rule, is that timing is everything with these rules. For those of you who have run pending billing and pending revenue recognition reports before, the first thing the report asks you for is a date range. From what date to what date can I recognize revenue, can I do my invoicing? Some of you may be putting dates in there to limit what it picks up. So when you run the rules on December 2nd, you make sure you don't pick up anything in December, so you put an end date of November 30th. These percent complete rules do not pay attention to those dates. So if you run the revenue recognition on December 2nd, it will pick up all approved time in the consideration for percent complete up to December 2nd. Okay? There's no way if you put November 30th on there, it doesn't stop and then go back and say, oh, what were the approved hours as of November 30th? It doesn't pay attention to that date. So timing is really important when you're using a percent complete revenue recognition rule because it's a as of today type calculation. The other thing to keep in mind is when you're dealing with milestones, milestones don't have any hours on them. So there's really no way for the milestone to know it's complete by people putting time on the system. So you have to manually set milestones to, maybe you turn on, there's a switch in the system. It's something that you can turn on yourself. It's in the project settings area of the system, where if you close the milestone, it changes the milestone to 100% complete automatically. That's a pretty common practice so that project managers can just do the one-click checkbox and save it, and it would take care of the status of the milestone. The other thing to keep in mind is when you have a series of milestones or phases, milestones or tasks that roll up to a phase, the phase does not actually average the percent complete across the tasks and milestones that belong to it. What it does is it takes the total planned hours, the total estimated hours, depending on what feature you have turned on, and the total approved hours across all of the elements, all of the tasks and milestones that it belongs to it, and then recalculates percent complete based on those values at the phase level. The reason that's important to point out is that if you have a phase that only has milestones in it, your phase will never be 100% complete because a milestone, by definition, has 0 hours on it. If you close it, it changes to 100% complete. If you close every single milestone in that phase, they're all 100% complete. The phase itself will still be 0, okay, unless you manually go and change it to 100% complete by closing the phase. Okay. So just be aware of that because the phase really recalculates the percent complete for itself. So that was the percent complete rule, and I do find that those rules are used very often for milestone recognition and fixed fee delivery. Now there's a couple other rules, expenses and purchases rules, which I get questions on a lot as to, well, why would I use this rule versus the as-billed rule? And those are actually really good questions because the expenses or the purchases rule, if you have generated, if you have done expense billing or purchases billing with purchase items, then you can use as-billed to recognize those expenses and purchases as revenue. However, the thing to know about these rules is that if you set up an expenses rule or purchases rule, if your company uses multi-currency, the expenses and purchases rule may use a different date to index into the exchange table than your invoicing. So if you ran your invoicing on maybe the 3rd of October and you set up the system so it's indexing into the foreign exchange table based on the invoicing date for the conversion on your report, the expense rule may use the date of the transaction, for example, to go into the foreign exchange table. So the expenses rule and the purchases rule do not pay attention to what the billing rule used for foreign exchange. It uses its own date, which may be the same and may be different depending on the configuration of your system. Okay. So I typically see expenses and purchases recognized by the as-billed rule, unless the switch is turned on that says you can't recognize any revenue unless it's on an invoice, and the as-billed rule pays attention to that. Switch. The expenses and the expenses and purchases rule does not pay attention to that invoicing required switch. So you can actually still recognize revenue and purchases without invoicing required. So there's a couple of, these are more like workarounds, I guess you would say, if you have it's sort of in a pinch. I typically see the as-billed rule used instead of these individual rules when it comes to revenue recognition. Now, there's another fixed fee rule that is called fixed fee on date or milestone, and this is a bit confusing because it has the word milestone in it. But when it says milestone in this rule title, it actually means the date of the milestone. So unlike that fixed fee on percent complete example I gave earlier, where I changed the milestone to 100% complete and then I can recognize a certain amount of money, this rule would only pay attention to the date. It doesn't matter whether the milestone's open or closed, 100% complete, 75% complete, whatever. Okay. It only pays attention to the date of the milestone. So this is really a date-based rule, and the date-based rule would be used if you have a known date on when you can recognize the amount of money, okay, or if you're doing some kind of like revenue adjustments. When I see the need for this rule is usually needed if you need to recognize maybe a contingency amount of money at the very end of the project because you're holding it back on a fixed fee project in case you need to recognize revenue after the project's done as a contingency if you have to if you go over budget at all, so you don't have to take any kind of revenue reversals along the way. So the fixed fee on date or milestone, it's not used very often in revenue models unless you have sort of a holdback or a contingency situation. Or if you're doing some kind of like a journal entry adjustment, maybe a rounding type of revenue amount. You can always create a revenue transaction manually in OpenAir. I always like to sort of suggest the creation of the recognition rule instead of a direct transaction creation, because if for some reason you had delete and rerun revenue, any manual transactions you created would also just be flat out deleted. You wouldn't be able to recreate them. So, so I always encourage people to create a rule so that you have something to fall back on in case you have to make some kind of adjustments. So we have two more types of rules left, and they're both quite interesting. And this one is called incurred versus forecast. So the name's not, the name doesn't really explain what it does, but basically this is a percent cost complete rule. So unlike the percent complete rule, which uses an hours-based metric, this is the cost of the hours delivered by people and the percent of cost complete based on the level of effort that's expected. So this model is used for companies that have maybe varying types of resources on the project, where and their revenue policy is the more expensive resources earn revenue faster than the less expensive resources. So I see a good mix of percent complete and percent cost complete revenue recognition policies across companies. So if you're doing a cost management, if you have cost loaded by person in the system, this is a nice rule to look at. It does you have to tell the rule where the baseline of effort comes from. So unlike the percent complete calculation, which deals with planned hours or estimated hours or budget hours as the case may be, the incurred versus forecast rule actually can plug into your resource scheduling. So if you're using bookings, it would use the booked hours. If you are using the estimated hours feature, it would use the estimated hours feature. So this is one of those, it's one of those nice revenue models that actually depends on your resource management as well for it to be able to do its calculation, its percent cost complete calculation. Okay. The other nice feature that this rule supports, which is sometimes a driver for the need of it, is it will actually create a percentage revenue recognition transaction per person working on the project. So if I have a team of 5 people working on the project and I want to track the revenue earning based on each person, using the incurred versus forecast rule, you can actually create individual transactions that total up to the amount of money you should recognize for a certain period's percent cost complete. Okay. So the rule itself is deceptively simple to set up, but there's a lot of calculations behind the scenes here. Similar to the percent complete rule, you set up the amount of money that you would put, that the whole project would recognize. And then the incurred section is how actuals are being brought in, approved hours. It's very similar to percent complete, so approved hours, but that's multiplied by the user's cost. And the user's cost is the level 1 user's cost in the system if you're using multiple levels of user cost. Maybe you're including receipts in this or purchase items. And then the forecast, you have to tell it, where do I get my baseline from? Where do I get my total effort? And here is where you can plug into approved and booked hours, which would be the resource management process, or an estimated hours based on the tasks with hours remaining and estimated hours. Or you can just flat out say, I expect the project to be this much cost, and you can put a total amount of money in, like the total planned receipts or the total planned purchases, and just force a fixed cost amount to be put onto this rule and measured against if you wanted to. Then at the very bottom there's this checkbox that allows you to create a recognition transaction per person. And what it's going to do is it's just going to figure out the cost amount shared between the 5 or 6 people that are working on it at this point in time and generate a transaction for each of them. So if you have a compensation model about revenue earned, this would be the rule that you would want to use for your fixed price projects instead of having to use that spreadsheet that you may be doing where you're sort of manually figuring out the allocations across people. Now, what if you are not really tracking costs? You don't really care about the cost tracking, but you still need that transaction per person because of revenue earnings. You can actually use this incurred versus forecast rule, but you can set the cost of every person to be a standard cost, like $1, or a single cost rate, $100 per hour or something like that. If everyone had the same cost, then basically this turns into more of an hours-only calculation versus a cost per percent complete because everyone has the same cost. So there is a way to sort of trick the rule into thinking it's doing cost percent complete, but to you everyone has the same cost, so it's really an hours percent complete calculation. And the last rule is the time project billing rule. So this one is fairly simple to set up, but it's interesting how it was set up in the system, how it was introduced into the system. So this rule will allow you to recognize revenue directly from approved timesheets, okay, bypassing the whole invoice process if you wanted to. So there might be situations where you have to do that, but usually there's a scenario that I like to use this for, which is license carve-out type revenue recognition, and I'll show you an example shortly. So the time project billing rule, would only be used if you need to drive revenue separate from invoicing, drive it from timesheets, or you have some kind of different hourly rate from the invoicing versus the revenue recognition. And in those cases, how would you be able to set up revenue to recognize something different than what was invoiced? Okay. How the whole time project billing rule works, though, is it's not actually a complete rule. The rule itself only exists based on the definition of a related time billing rule in the system. So you do always have to have a time billing rule, and then when you create the time project billing rule, you point it back to the billing rule that you created. So instead of the developers basically creating a whole nother duplicate form that looks exactly like the time project billing rule, what they basically said is don't bother configuring a recognition rule. First, generate a time billing rule that has all of the controls on it: the caps, the rates, the filters, the accounting periods, maybe date ranges, anything that you could put on a time billing rule, and then save that, and then tell this revenue recognition rule just to look at this time billing rule for its definition. Okay, so there's really nothing to configure on the time project billing recognition rule. It literally points back to whatever template you set up over here in the billing area called the time project billing rule, or time billing rule. Okay, so first off, you have to set up your time billing rule, and you have to configure everything that you would need to basically control the revenue. And then you create your time project billing rule, recognition rule, which is a really long word to say, and just tick the box and link it back to it. Now when you do that and you run billing would then, of course, generate charges from the timesheets. This revenue recognition would also recognize revenue directly from timesheets. But there would be a reason why you would do this. Okay? There's a little trick that you can use where you set up that time billing rule as your template, you create your recognition rule which points back to it, and then you can go and inactivate that time billing rule under the billing rule section. So that time billing rule does not actually generate any charges. It doesn't try to invoice anything. It solely exists as the definition of what the revenue recognition rule has to understand to be able to do its revenue transactions. So it's a little bit of a trick, but you have to create the time billing rule, you have to create the revenue recognition rule to point back to it, and then go and inactivate the time billing rule, and it will not generate any charges, so you won't sort of run into the problem of maybe duplicating invoicing or creating charges when you're not expecting to create charges. Okay, so there's a way to sort of trick the system that way. Now, why would I even want to do this? Like, why am I going into this detail? Why would I even want to do this? And the best example I can give is the VSOE license carve-out situation, where there has been a bundled deal for those of you who sell services and licenses together, for example. And the services, the license, maybe the license fee is a certain amount of money, and the services have been thrown in for free. So they've been bundled together for free. But those of you who may be familiar with the VSOE principle is there's still a value of those services that you have to accommodate. So the customer may think they're getting the services for free, but behind the scenes you basically have to borrow revenue from the license that's been booked and give that to the services organization so that you see that there's a certain published rate that you're adhering to. So in that case, if you wanted to do an invoice out of OpenAir, you would do an invoice. In this example here, I have the customer thinks they're getting $85 an hour for invoicing, when in fact, behind the scenes, services is earning $105 an hour because of the license fee adjustment between the two organizations. So the time billing rule 1, which was set up on the project, is set up to basically bill the customer for $85 an hour. A second time billing rule has been set up for a rate of $105 an hour. I go and I create my recognition rule, which points back to rule number 2, and then I go and inactivate number 2 because I can really only have one time billing rule running unless I have all kinds of filters and stuff. So the time billing rule 1 would control the creation of the charges for invoicing. Time billing rule 2 doesn't do anything. However, when I run revenue recognition goes and looks at the definition of project billing rule number 2, and it says, oh, I can recognize every single one of these approved hours at $105 an hour. For those of you who are in the finance organization and are looking at this, you're probably thinking automatically, well, doesn't that give me sort of, WIP, work in progress, type revenue reporting? And the answer is yes. It will always have a WIP on this project, just simply by the way that it's doing the license carve out. And we'll talk about that in just a second. But that's how the time project billing rule works. So it's a way to do revenue recognition directly from timesheets. You can actually do a separate rate if you want using these rules between what's been billed and what's been invoiced. Okay. Now, accounting periods are used quite often. I find accounting periods very useful on revenue because you may be recognizing revenue in a certain period, so you want to associate a certain period to every single revenue transaction in the system, versus invoicing, which may have an invoicing date of August 1st for July work, but all of that revenue is July, so you use accounting periods in the system. And if you're not familiar with accounting periods, it's a feature that's you can set up in the system, and on the rule, the revenue recognition rule, there's an area of the rule where you can define what period does it get when the rule is run. When the rule is run, the transactions that are generated will get stamped with an additional date field called an accounting date. And I think I have a picture here. Yeah, so you would basically set up, say, when the rule runs, apply the current accounting period as the date on this transaction. And then someone in your organization would control what does current accounting period mean. Like this month it may be December, right, is the current accounting period. And the accounting periods can be set up to accommodate your 445s, your monthly calendars, your quarterly calendars, whatever the accounting period calendar looks like. But the key here is that once you have that accounting date on your transactions, then you really want all of your reports in the system to use that accounting date as an index. So anytime you have like a company summary report or a financial report in OpenAir, you'll want to check and make sure that these date fields that show up actually are using the accounting date versus the transaction date, because that could be very different, as many of you know, from what was actually booked in accounting. In the reporting in OpenAir, there's standard reporting values. You may already be familiar with project billing, invoiced amounts, project recognized revenue, but at the project level, there's also automatically project work in progress or WIP revenue and project deferred revenue. Now, OpenAir's calculations of these are very simple. It's invoice, what's been invoiced versus what's been recognized for revenue already according to the project. So if I've invoiced $100,000 and I've recognized $10,000, I've got deferred revenue of $90,000, and that's what will show up in the report, and no WIP. If it was reversed and I invoiced the customer $10,000 and I recognized $100,000, I've got $90,000 in WIP in the system. So it's just standard calculations for reports in OpenAir, so you can use those features to the automatic calculations, or of course you can actually do your own custom calculations in the system to generate maybe a breakdown of the types of revenue that you have. For example, if you're not aware that there's a standard reporting value called projects recognized revenue. There's also a standard reporting value saying projects recognized revenue from expense item charges. but there is not a standard revenue value called projects recognized revenue from time. Right? You would have to create that yourself, and this calculation here on the screen shows you that. Revenue minus revenue from expense items by default gives you time, time revenue, unless you're dealing with purchases, which is, you can do some more calculations to get the purchases out. And finally, with the custom time ranges, for those of you in the accounting world, you tend to look at sort of opening balance, current month, closing balance type reports often. And OpenAir actually can accommodate those kind of reports by setting up custom time ranges. What a custom time range is you basically tell the system how do you bucket the transaction information according to specific date ranges that you give it. And in the example I have on the screen, I have two date ranges here actually. One is called past and one is called August 2013. And then by definition, OpenAir's summary reports add the two together to give you a total. So essentially I'm doing an open balance, current month, closing balance type report. And that's nothing more than setting up a custom time range that understands what are those two periods, past and August. Okay, so you do have to set up one for every accounting month, but it's a once a year thing. And if you can take 5 minutes to set that up, then you would have this capability to do open balance, current month, closing balance type reports throughout the whole accounting year. Now, deferred revenue in system, I said it automatically computes it based on invoicing and revenue amounts, but there is another feature that I'll touch on briefly called revenue containers. This was introduced back in 2011 and enhanced in 2012 regarding a way to track more transactions related to not only revenue but deferrals and accrual transactions, talking more in terms of accounting principles in OpenAir. Okay, so what the concept of a revenue container is that you generate revenue and you can submit revenue into a review and approval process, and the revenue is tagged or computed as accrued or deferred based on the state of invoicing in the system. And the container itself has sort of a balance view, a balance sheet view. So each container is a balance sheet view to show what the state of the project is at that point in time when that revenue container was created, on how much, what the amount of accruals was versus what was the amount of deferrals because of a certain amount of revenue that got booked on the project. There's actually different revenue stages associated with this, so this is a whole feature activation, and it deals with open containers, and then once the container is finalized or booked, it creates deferral and accrual transactions so that you know how much of the revenue on a project is deferred revenue versus accrued revenue in the system. And the revenue containers themselves can be generated directly after the invoicing activity happens. So you generate the invoice, there's a one-click feature, and it'll create a container which then will have the balance sheet information of how much of that invoice amount, for example, could be accrued versus is deferred in the system. And I have a scenario here to kind of explain the feature a little bit more. So if there's no invoicing done on a project, let's say, but you've completed 25% of the work, your policy is that you can recognize $10,000 based on the percent complete rule. A revenue transaction is generated, so you're still running revenue recognition, but you generate the revenue transaction into what's called an open revenue stage. Then you create a revenue container which grabs the transaction and it sees that it's an accrual, so it recognizes it $10,000 as an accrual in the revenue container. The revenue container then is submitted for approval, and the transaction is moved into what's called the accrual revenue stage. Then invoicing is done, and invoicing is done for $25,000. Once the invoicing is done, then a revenue container is generated which takes the $25,000 and says, oh, well, I've accrued $10,000 already, but I'm going to have to, the other $15,000 I have to defer. So it will, in fact, create a balance sheet that shows the $10,000 accrual. It already knows about the $10,000 accrual from the previous container, and it'll book another $15,000 as a deferred revenue transaction inside the container. So the container is sort of grouping together balance sheet actions along the way with a review and approval process that is part of the revenue container situation. I've run into customers that do need this functionality when they are trying to track month by month what revenue did they defer each month, like how much did they defer each month or how much did they accrue each month, versus just running a revenue recognition report and doing a standard deferral or a standard WIP report. The standard deferred and WIP information is based on what was invoiced and what was recognized at the time versus maybe a specific action that may have impacted when that revenue transaction got generated. So there's a lot more information on this feature in the release notes related to that. If you would like more information, we could certainly point you to those release notes or help you understand this feature a little bit more. But it really is only necessary for customers who have to track sort of the what happened on deferral and accrual transaction level inside the OpenAir system. Okay. So with that, we're going to open up the phone lines here in just a second for some questions. But I wanted to point out that the revenue functionality in OpenAir is actually very robust. It's very powerful. It handles almost any type of revenue challenge. There are a couple of exceptions, but for the most part, it will handle all the revenue transactions, which is why in many times when you're interfacing it with an accounting system, you may choose to have OpenAir pass some of the revenue information over to your accounting system and just have OpenAir do the calculations. Okay. There are a lot of different recognition rules. There's ways to deal with fixed price projects very easily, prepaid projects, and if you have some controls versus accounting versus project management, all of that can be considered based on which rules to use when to support your policy. I would like to thank everyone for coming again to our monthly webinars. We are continuing them, like I said, in January for 2015 with another exciting lineup, hopefully, of webinars. And if you would like any information about this webinar or any other webinar, we encourage you to reach out to us at info@topstepconsulting.com. Those come directly to me, those emails. We also participate in the OpenAir Users LinkedIn group. And of course, you can always find lots of useful information on our website, including the recording of this webinar once we produce it and put it out there on our website. So thank you again, and have a wonderful rest of your day.
Thank you.
Thank you.